Just to start things off with this accounting screencast to make sure we do things correctly because we had to rush in class. So this is a friend of mine I went to high school with. Works for EY, Ernst & Young, one of the biggest accounting firms. And so his story in the accounting magazine was about using drones to count cars in a and why would he be doing that? Why do that? Well, as an accountant, he previously had to go and inventory every car on the lot. However, you know why? Well, if you were going to do business with this truck dealership, you'd want to know how much money they had. And sure, they could tell you their bank statement, and that'd be easy enough to understand. But there'd be other things. There would be, the building they were on, the land, and you could go and again, estimate that. But there would all be all kinds of equipment and vehicles and things like that. So if they say they have 500 cars, 500 trucks on top, how do you prove it? Well, someone does actually have to go and count every single car. And I just mentioned it because he got written up because they would often go with clipboards and have multiple people go scour the whole property, count every single car that they could find. And then they decided, you know what we'll do is we'll use this drone, we'll fly it above the property, and we'll count everything that we see. And that proved to be a quick, accurate way to figure out how many trucks this dealership had. And it was a part of figuring out the financial health of the dealership. For the purposes of the law, they were telling the government that they were struggling and didn't, and had many cars on hand. Well, that might not, make sense. If they were telling a potential investor that they had a great business, but however, it didn't look like they ever made a sale because they never had any cars on their property. Again, that would be something that accountants could have to clean up. So here we go back to the idea of accountants and what do they do. So we want to be able to understand the balance sheet by the end of this. So I have this little cartoon because sometimes it's really mysterious what accountants do. Because partially they deal with numbers and people don't want to deal with numbers. So they decide that they will, that it's just they won't bother figuring it out. Also, there's sort of the idea that, they do all this accounting, they do all these financial statements, and then they end up, how did they create them? Well, I just went into this black box in accounting and they came out as financial statements. So this cartoon makes light of the fact that accountants sometimes are seen as being a little bit unusual and that people don't know what they do. But by the end of this screencast, you will know. So some key things to understand. Why do we account? Why do we have accounting? Well, it's the process of recording, analyzing, and interpreting the economic activities of a business. The first step is just recording. How many sales did a business get that year? Does anyone owe them money? Do they owe anyone money? What's the value of the car? How much did they spend on gas last year? All these things are relevant to the business, and the first step of accounting is just recording them by keeping receipts and by keeping records. The next step is analyzing. Well, what happened? Is this a profitable business? Is this a business that that you should invest in? Is it a business that you should refuse to invest in? Is it doing well? And then lastly is interpreting. For example, looking forward. You would go to the grocery store and they would keep track of what kinds of foods are selling well. And they might notice, hey, gluten-free bread is really selling out. We're often we're ordering twice as much as we used to. Let's decide to devote a whole section of the bread to gluten-free bread and make it a point of differentiation for Metro, and eventually using that accounting information to inform a business decision. So what do accountants have to do? They have to keep accurate records. We need to know what has happened first of all. Who owes money? If you didn't write that down and you kept forgetting, you're not going to be in business very long. informing business decisions. I always use the restaurant makeover example where Robert Irving confronts the owner about, how they don't charge the right price. And it turns out the owner didn't know how much the food cost. The owner didn't know how much they should mark up a traditional restaurant item. The owner didn't know how much they were spending on utilities, things like that. And as a result, they just were charging a bad price and they were in serious financial difficulty. Complying with laws, so if it's a publicly traded company, they will release their financial statements. You can read them and decide whether or not to invest. A charity must release their financial statements. Uh, and any business must pay taxes, and so they have to figure out how much tax should they pay. When you purchase an item, you'll notice there's 13% HST. Any Canadian business must keep track of their sales and send 13% of those sales to the government as part of HST. And just analyzing business trends, what new products should be introduced, what location should be closed. If there's a Canadian Tire in Leaside and it turns out that people aren't shopping there for whatever reason, maybe Canadian Tire should consider closing that location and opening up in a more suitable location.
What is accounting? Accounting is the language of business. Well, what is business? Well, you could say business is like somebody taking a hammer, building a house, and then taking his stuff that he made and selling it to somebody with money. Then they make their exchange and it's all good. Another way to look at business is that it is a magical box. You take raw materials, put it in the box, and then it comes out as goods that you can then sell and make money. That box is business. So let's say you have a business. You make something that costs you $100 to make and you sell it for $200. You have a profit of $100 and you're happy. I just told you a story about a business that made $100. So who should we tell our story to? You might want to tell your story to banks or investors. Banks or investors want to hear your story because they might want to lend you money or invest money in your business. Another person who wants to hear your story is Uncle Sam. He wants to tax you. We could break it down into 3 different people that want to hear your story. People on the inside, or internal users. People on the outside, external users, or the government. The language by which you tell these people stories is sometimes called managerial accounting for internal users, financial accounting for external users, and then tax accounting for government users. If you've ever taken an accounting class, it's usually going to be called managerial, financial, or tax. The actual language that external users want to hear your information in is GAAP, GAAP, which stands for Generally Accepted Accounting Principles. The government wants to hear your story based on the Internal Revenue Code. That is the standard by which you must tell your story. Now, internal users, what's the name of the language that they want to hear? It's actually whatever you want. There is no standard managerial accounting language. If you're a business and you're talking to an external user, you want to look good or show that you made a high profit. Everyone wants to brag about how good their business is doing. However, when you talk to the government, your objective is to make it look like you made nothing. Because if you're rich, they'll take all your money. Now, if you're talking to an internal user, your objective isn't really to look good or to look like you made nothing. It's really just to tell it as accurately as you can, because that's the information upon which managers and decision makers will make decisions. Now, your story might be the exact same story in every instance, but depending on who your audience is, you're going to use a different language. And each of these languages will actually tell a different story, even though it's based on the same actions of the business. In review, accounting is the language of business. Business is when you do stuff for profit. When you tell the story of your business, you're going to be telling it to one of a few different options. Internal users want to hear your story based on the language of managerial accounting. External users want to hear it based on GAAP, and the government wants to hear it based on the tax code. For more videos like this, visit accountingwit.com.
So I like how he talks about the language of business, trying to express what is happening to the business. And later on, we'll also talk about the different people who use accounting information, but just the understanding that some of it will be for the business itself, how to, Starbucks needs to know which drinks are popular so they know which to discontinue and which to sell more of. Some is for the government because of legal requirements like taxes, and then some might be for a prospective investor who wants to know the true status of the business. So the first thing we need to do is figure out how much the business owns, OWN. These are things of value that a business owns. What cash is in the cash register? Accounts receivable. Perhaps someone owes them money. For example, a hardware store, Home Depot, they have a lot of regular customers. And it might not be necessary for them to collect cash every time they deliver a bunch of lumber to a building site. Instead, they will invoice the contractor and collect payment within 30 days. That would be an example of accounts receivable. A restaurant that receives daily deliveries of fresh vegetables. Again, it does not need to pay every single day. It has this long-standing relationship, so the vegetable supplier might invoice them and then again accept delivery, accept payment 10 days later, 30 days later. It's not necessary to pay all at once. Inventory, what goods are in the store? A clothing store would want to inventory, how many shirts, how many shoes, how many pants, how many handbags, and understand, what the value of that is. A grocery store would need to understand how much food's in there. An electronics store would need to understand how much is in there. Once, because it's an asset, but also secondly, you wouldn't want people to be shoplifting, or you wouldn't want TVs to be going missing, or you wouldn't want food to go bad. So you keep track of inventory for two reasons. And any investments, any equipment like computer equipment, machinery, kitchen equipment, things like that. Vehicles, does the company own a vehicle? Not all companies own a vehicle, but that would be something that's worth money. And lastly, their building and their land, which they may own outright. And we list them in order of liquidity. How soon could we turn it into cash? So if you wanted to evaluate the health of a business, you'd want to know, hey, what are the short-term figures like? What's going to happen in the next 90 days? Because they'll have some expenses they'll have to pay. Will they be able to make those expenses? Will they be able to make, will they be able to make payroll? Will they be able to make their rent? And so we look first at cash and those short-term assets, those current assets like accounts receivable, which can easily be converted into cash. Other things, if Best Buy needed to sell its inventory, it probably wouldn't get full price. It might take some time to clear out the whole store. So again, inventory cannot be immediately converted into cash. They won't be, all the items will not sell instantly. So inventory is listed below cash and below accounts receivable. There might be things like fixed assets, which are permanent long-term assets, like the equipment, like the car, like the building. The business might own for 5 years, for 10 years, for 25 years for the sake of a building. And also when they choose to sell those, it won't be easy to sell. They won't be able to easily sell a building. They'll have to advertise, they'll have to list it. People will negotiate. They won't necessarily get the full amount. So assets, everything that a business owns with an N, is listed in order of liquidity. Well, and the opposite is liabilities. What do they owe with an E? Liabilities are amounts of money owed to other people. Well, why would a business owe money to other people? Well, they might have, certain accounts payable. For example, regular deliveries that they pay at the end of the month. Short-term, accounts payable would be short-term, no more than 30 days before they have to be paid. And it just makes sense to invoice people and deal with your regular customers on a cashless basis. They might need to renovate, so they might have taken out a loan from a bank or from a private investor. They might have taken out a car loan to buy a vehicle. They might have mortgaged their property. They might have had 20% of the money, and they paid that as a down payment, and the rest is mortgaged, and they make a regular mortgage payment as part of the finalizing their complete ownership of the building. And just other debts, it's sometimes you do, as part of expansion, you take on debts in order to get the money to expand, because once you grow your operations, you'll easily be able to pay more money, and you'll make more profits. So what's left over is owner's equity. So that's the owner's investment in the business. And if it's a sole proprietorship, that one person owns all the money. If it's a corporation, the shareholders own all of it, and they call it shareholders' equity. And that's assets minus liabilities. So this is our accounting equation. The fact that on one side of the scale, on the left side, is assets, everything that has a value. And how did we acquire those things that had value? Either we borrowed to purchase them, we mortgaged to purchase the building, we borrowed to purchase the car, we received delivery of some supplies and we're going to pay the accounts payable later, or the owner put in the money themselves to acquire the item. So the owner's stake is the item. I mentioned in class the Donald Trump case. So we know that Trump's business has certain assets. But his net worth is not only those assets. It seems like he owes $400 million to an unknown party. So when we want to figure out how much is Donald Trump worth, and we look at the Trump Corporation, we would have to take out all the money that's owed to other people, because that does not belong to Donald Trump. So assets equals liabilities plus owner's equity, and that's always going to balance. And we list those on the balance sheet. So the balance sheet is the company's financial position at any given moment. A balance sheet's going to say an exact date, as of August 31st, as of December 31st. It's always going to have the date, because the next day, transactions happen, sales happen, expenses happen, income is earned, and the position is different. The balance sheet lists on one side, on the left side, assets, and on the right side, liabilities and owner's equity. Sometimes it's assets on top, liabilities and owner equity below. It's called the balance sheet because those two columns, assets compared to liability and owner equity, always balance. And it helps us understand, okay, a business may own a lot of things, they may have a lot of cash on hand, but it's not actually theirs. It might be a liability that's owed to another person, like a bank, or it might turn out that yes, it does own a lot of things, and those things belong to the owner who has a high net worth. Here's a little example of a balance sheet. So we start off, we list the name of the business, we list balance sheet, we list the date. There has to be a date. You can't just say September 2016, you need the exact date. And then we list on the left-hand side the assets, and they're nicely, lined up so it's easy to add. Cash, accounts receivable, office supplies, parts, equipment. This is an auto repair shop, so a parts inventory would be things like an extra, an engine. And the equipment could be like the torque wrench, or the lift that the truck goes on so the person can work on underneath. The building and land would be the garage and the property that it sits on. We do a single line to indicate that we're adding up, and then total assets, we list them out here, and a double line indicates that there's no more information in that column. So just so people know, nothing got printed on another side of the page. Double line is your final sum. And then on the other side, we have our liabilities, again, in order of liquidity. Our accounts payable. Okay, so we owe a few of our regular accounts $350. $7,350. There's a bank loan, there's a mortgage loan. You add up all the liabilities, what's left over belongs to Mark Blanchett, so we say owner's equity, then the name of the owner, Mark Blanchett, comma, equity. There might be multiple owners, so we would name each owner, so we know, okay, Mark owns 2/3, Jeff owns the other third. We total it all up, and again, a double line means that there's nothing more in that column, and on a balance sheet, assets is always going to equal liabilities plus owner's equity. So if these two lines do not line up, you have an issue. And hopefully that demystifies what accountants do.